안녕하세요. 한국경제신문의 김현석 뉴욕특파원입니다. 오늘은 특별 세션으로 꾸며봤는데요. 미국 중앙은행 페드가 가파른 금리 인상과 양적 긴축 QT를 하겠다고 경고를 하면서 미국 경제와 시장의 불확실성이 커지고 있습니다. 네드데이비스리서치의 그 수석 이코노미스트인 미스 알레한드로 그란드를 모셔서 궁금한 점들을 물어보려고 합니다. Hello, Miss Grandel. Nice to meet you. And I am Hyun Kim from the Korea Economic Daily. And I am so happy to be able to do this interview. Let me start with the first question. A rapid balance sheet reduction and a series of a rate hike now seems inevitable. What path do you expect the Fed to take in QT?
First, I want to say thank you for having me. It is a pleasure to be here. So the Fed is definitely on the way to QT, and I think that was actually clarified a bit more yesterday with the FOMC meeting minutes. We're looking at roughly a total of $95 billion per month. We've actually been calling for QT for some time, but I would say the minutes revealed a slightly more aggressive pace, but just slightly than we had originally anticipated. You do have to keep in mind that our starting point is a pretty hot economy, high inflation, relatively large balance sheet. So if we want to think about the pace, as you mentioned, it'll still take about 3 years to get the balance sheet back to normal or at around 20% of GDP.
And currently, the market expects the policy rate to rise about 250 basis points this year. And some believe that the Fed will not be able to raise rates that much because the economy slows. What do you think of about this argument?
So 250 basis points this year. So throughout, I'm assuming throughout the remainder of the year, that's 50 basis points per meeting. We're looking at slightly less than that, but not hugely different, partly because the balance sheet reduction will also do some of the tightening. But I thought you mentioned a really interesting point. Why would the Fed do this if the economy is slowing? But I think it's really important to note that the US economy is starting from extremely high levels. So keep in mind that real GDP grew almost 7% last year. So that's a pretty strong number. And our expectation for this year is 3 to 3.5%, which is a pretty sharp slowdown from last year, but historically that's pretty robust growth. And I think the problem is if the Fed waits too long and kind of waits for these extraordinary factors to play out, it will lose its credibility, and that in turn can, change inflation expectations, and they can become entrenched and become a self-fulfilling prophecy. And I think another sort of underappreciated aspect of the inflation that we're seeing in the United States is a lot of it is aggregate demand oriented. So by the Fed tightening policy, it may not be able to do anything about the supply shocks and what's going on with the Russia-Ukraine crisis, but it can help relieve some of the demand function, which as I said, is sort of an underappreciated driver of inflation in the US.
And some still expect inflation to subside in the second half of this year, and due to the easing of supply chain disruptions. Do you see it as reasonable expectations at this point?
Yes, we're some of those folks. We actually do expect inflation. So we don't expect inflation to get back to pre-COVID levels, but we do expect that year-to-year growth rate, that inflation rate to ease in the second half of the year. Some of it is the easing of supply chain disruption, but a few other reasons.
And when will the inflation peak? How do you see inflation going this year?
Yeah, so end of this year, our year-to-year estimate for December is 4 to 4.5% inflation. So that's lower than where we are right now, obviously, but still quite a bit above pre-COVID levels. And there are a few reasons for this and why we expect inflation to ease. One is just mathematical, right? Base effects. So base effects have boosted the number, starting mid last year to now. And one would hope that just mathematically that higher base won't make the number look as high. But I think also another really important point to note is that if you look at the underlying drivers of US inflation, I mean, it is going across the board, but really what's boosting US inflation is consumer durables. So if you look at core commodity CPI, it's up over 12% year to year. If you look at core services CPI, it's up around 4.5%. So still a strong number, but not nearly as high as core commodities. So if we're correct that we continue to adjust to COVID and we transition back to services and away from those consumer durables, keep in mind there's only so many refrigerators we can buy, so many TVs we can buy, then I think that alone will help see that shift. And then you add in the fact that that demand driver due to slower growth is easing. We don't have as much pent-up demand as we did last year. And obviously there's not as much monetary and fiscal support.
What do you think about the rent or the wage, something like that, that is more persistent, the factors?
It's definitely more persistent. And quite honestly, it's one of the reasons why we think US inflation will stay higher for longer than, say, other countries around the world, partly because that rent and that housing component is such a large part of the CPI. So a lot of it is just calculation reasons. But what we have found is usually when you see a surge in housing prices, it tends to manifest itself into CPI about 12 to 18 months later. So we're sort of in that part right there. So for sure, it'll create, a strong foundation to the overall CPI. But as I mentioned before, that core services CPI is still, which includes that shelter component, it's still up around 4.5% year to year. It's nowhere near as close as where we're seeing the rise in core commodities. So even just shifting our, spending back to the services side should see the CPI growth slow, despite the fact that the, shelter component will continue to contribute to the upside.
If Russia and Ukraine ceasefire, will inflation come down? How much? And some predict that the sanctions will continue to put upward pressure on the inflation, and although the oil and agricultural products price will drop slightly.
Yeah, no, it's a great question, and I have to admit, I mean, any good news is good news, right? Whether there's at least for humanitarian reasons, right? A ceasefire would be great. Finding another commodity source relatively quickly, of course, that would be great. So it, perhaps it may alleviate some pressures, but I do expect them to remain elevated. I really think this was a game changer, at least in the, on the Russia front. And I, like you said, I do suspect that the sanctions will remain in place. I mean, this was an unprovoked attack. Reportedly, the atrocities on Ukrainian civilians, I mean, this isn't going to be forgiven easily. And ultimately what happens is if you have a large resource market, such as Russia, which exports a lot of the world's oil, natural gas, wheat, copper, I mean, a lot of things, they just may not be available to large parts, especially of the Western world, for some time, if ever. And holding all else constant, when you're reducing a supply side of things, that means higher prices. Now, one important thing to keep in mind is humans are very adaptable and elasticity. So our ability to substitute and, adjust preferences both on the demand side and supply side does change over time. So it becomes more elastic. So, ultimately new sources will come up, demand shifts will change, perhaps demand will slow, but in the near term, maybe alleviate the pressure somewhat, but not a whole lot.
Now, what do you expect the 10-year U.S. Treasury yield to be at the end of the first half and this year?
I talked to our fixed income strategist because he's the individual that comes up with this forecast. Okay. And right now, clearly what's happened, even, as of yesterday, has definitely made that forecast very, very difficult to do. And, what many of us were thinking at the beginning of the year was very different than what we've seen so far this year. But his somewhat working estimate is maybe about 2.75 for year end.
And do you think yield curve inversion is a reliable indicator of a recession? Which yield curve should you primarily look at?
The question I've been getting most from clients recently, obviously because it's happened, right? We've seen a yield curve inversion. And historically, it's been a good indicator. And, as anybody who watches data, we would never shrug it off. But one thing I do want to point out is this is one of our mantras at NDR is we don't hang our hat. We watch data, right? And we don't hang our hat on just one indicator to make a recession call. And partly because of, and this is the way we run a lot of our modeling. And it's because something that could have been a good indicator in the past may not be that great of one in the future. Things change. So the way we like to look at things is to look at a broad range of indicators. And if the vast majority are consistent with recession, then obviously that increases the probability that we're in recession. So even just looking at the yield curve alone, you maybe want to see confirmation from other yield curves. So we're not seeing confirmation on the real end. Fed Chair Powell has looked at the 13-month, 18-month forward. So there's a lot of different ones you can look at. But we also are looking at some of our data, some of it's internal. So we have economic models, recession probability models. Jobless claims are really good recessionary indicator. And the numbers that came out this morning were phenomenal, very far away from recession. Right? Financial conditions, consumer and business sentiment, PMIs. We need to see that confirmed across the board.
That means you are not worrying too much about the inversion, right?
Obviously a worry because it's here, right? But maybe not as much as some other folks are, because we'd like to see a little more confirmation across the board. I mean, honestly, a lot of what the inversion is telling us is that we're seeing a lot of short-term inflationary pressures. So that implies that, the short end of the curve is going to rise, but there's an expectation that over the long term, there won't be as much inflation.
Right. In the past, the 2 to 10-year yield curve did not inverse until a significant period of time after the beginning of the rate hike cycle. But now, just 2 weeks after the first rate hike in this cycle, the inversion has happened. So there is an argument that the recession could come quickly than past the cycle. How do you see it?
Yeah, I mean, again, this is just such an unusual circumstance. If you think about the driver of inflation, it was mostly COVID related. And it's really hard to look at historically and find comparative, instances. You have to go back over 100 years, and it was a totally different world back then. And then we also have the war. So there's a lot of just sort of interesting circumstances going on that may be causing this to happen so quickly, because the surge in inflation happened so quickly. And then, as I mentioned, I think this general view that over the long term, we won't see as many inflationary pressures, perhaps because there's still a lot of secular or long-term disinflationary factors at play. I think that's a lot of what's driving the curve now.
Mm-hmm. And how do you think the U.S. recession risk in this year and next year?
So for this year, I think it's, I've kind of alluded to it. We still think it's a pretty low probability. Again, if you're looking at growth of 3 to 3.5%, that is nowhere near recession. Very, very strong. And again, you're starting from a very strong starting point, right? Obviously next year, the probability of recession increases. It always does over time. So it's very easy, you tend to actually look at a lot of surveys, and this was even before the global financial crisis. And it was pretty common that the general consensus was, we'll be in recession next year, the year after that. So that actually seems to be the norm. But I think, part of the problem with just looking over the next year or even 2 years is a lot of things can happen. I mean, what's going to happen with COVID? What's going to happen with Russia? What's going to happen with China? So there's a lot of unknowns for sure.
And mortgage rate over 5%. Will the U.S. housing market go into recession soon?
We definitely expect the housing market to slow. Most of our analysis has found that when you see a large jump in mortgage rates, you do tend to see the housing market slow. And then also add in the fact that there just hasn't been a huge amount of supply. And so this was just, starting off with lack of supply following the global financial crisis. A lot of housing builders were burned, but further being hurt right now due to the resource shortages. Obviously, again, as I mentioned, over time, costs, supply, demand imbalances adjust. But we think there are a few things that might be holding up the market or housing market now more so than, say, post-global financial crisis, for example. One is there are more cash buyers this time. So you have a lot of people buying second homes. You have a lot of investors buying. So in this case, the mortgage rate doesn't really matter as much. And also COVID, I guess you can guess I'm at home right now. So, COVID not only changed my work from home, process, but did for a lot of other people. And we still think there could be some regional shifts. So there might be more pockets of regional demand. So I'm actually located in South Florida, and we have been a very popular area, California, Washington, D.C., New York. In my neighborhood, I see these license plates here. And then another important thing to keep in mind, and this is more from a longer term perspective, is the demographic story. We have aging millennials. I know it's hard to believe that millennials are aging, but they're getting in their 30s, some in their early 40s, and they're a huge demographic cohort. In fact, bigger than the baby boomers. So all of that, household formation should also be a driver for real estate or residential real estate in the long term.
American companies have responded to inflation by raising prices. How long do you think can American consumers stand up to these price hikes?
Yeah, it's definitely a new world. And I think a lot of it depends on how persistent it is. So if you look at, say, anecdotal evidence or even consumer surveys of inflation expectations, or even the yield curve, which we talked about before, I think generally there's this view that this price surge that we're seeing right now is it's temporary and due to extraordinary circumstances. So first, obviously, being the huge supply demand imbalance we got because of the COVID-19 pandemic. And then now adding on to that, because the pandemic's not over, right? The Russia-Ukraine crisis. I would say if long-term inflation expectations get unhinged, well, that's what I talked about with respect to the self-fulfilling prophecy. Consumers would be more accepting of the higher prices. On the other hand, if the economy and the job market weakens, businesses, especially those in that discretionary spending category, may not be able to get away with it. So I think for now it's more short term, but we need to watch inflation expectations and how the economy develops to see if it's sustained.
There was no disruption to demand in the United States when oil reached $130 per barrel. How high will oil price rise before demand disruptions? And what is your prediction for oil prices in the second half of this year?
Yeah, no, I love that question because that really speaks to the inelasticity of oil. It's an essential good, and in the short term, if prices rise, it's very difficult for us to alter our spending habits with respect to that type of commodity. Over time, obviously, consumers can adjust and buy more fuel efficient cars, assuming they can actually get one, because there's obviously a vehicle shortage. They could commute, ride bikes, walk. I mean, there's things people can do. In terms of our estimate, we've done a lot of calculations just to show how higher oil prices do impact GDP growth. So in the G7, for example, our calculations show that, say, if we were to sustainably see a $20 increase in real oil prices, that would reduce real GDP growth by about 40 basis points. So not enough to put an economy in recession, but you do feel some bite. Because the US has has become more oil, it doesn't rely so much on foreigners for oil. We've noticed the impact is smaller on the US economy. However, economies like the Eurozone, which do rely a lot on oil for imports, it does impact their economy a little more negatively.
The business cycle seemed to be very short compared to the last cycle. In recent stock market, defensive stocks such as utilities, healthcare, and consumer staples are leading the market. Are we already in the late cycle?
It is important to note that the previous cycle was
10 years long.
Yeah, it was really, really long. Exactly. And I think, and it was unique in the sense that even though it was long, growth wasn't very strong. We weren't seeing 7% growth, 3 to 3.5% growth, right? And also, if you look at the output gap in the United States, it remained negative for about a decade. So that sort of plays into that. So that's one of the reasons why the cycle was so long. In this case, it's just a totally different story. I mean, our cycle currently right now is being driven by COVID. So we had a huge negative output gap in 2020 because of the pandemic. And then in 2021, the United States went back into positive territory, a hugely positive output gap, as of last year. So in terms of how we're currently positioned at NDR, our sector strategist is very, roughly in line with what you said. We're defensively positioned with liking healthcare, utilities, consumer staples. Also, we have some overweights in value-oriented sectors such as energy and materials, which again plays into some of the supply shortages, what's going on with the Russia-Ukraine crisis. So, part of that is a factor of, you're right, as the maturing economic cycle. It's also important to take into account other cycles. One is the election year. So this year we have a midterm election, and usually during election years, overall markets tend to be a little choppy, and we tend to favor defensive leadership. And one of the reasons is markets hate uncertainty, right? We all know that. They don't care who's going to be president, what party. They don't care, whether the House will lean one way or another. They just don't like uncertainty. And so often once you're moving, since the election is toward the end of the year, there tends to be some volatility just based on that uncertainty.
You mean that means it's a kind of a late cycle, but we are not in the late part of the cycle, right?
Often, and this is actually great work that's been done by our chief US strategist, but he'll often talk about that you can have recessionary cyclical bear markets, and then they can be followed by echo bears, which are not associated with recession. And so sometimes you can have these little cycles within that without having a recession, and then you go back to another cycle going forward where maybe you can switch more to high beta and then eventually move toward defensive. But at least based on where we are in that segment of the cycle, just given that the economy rebounded robustly toward the end of 2020, just alone, and the fact that we're seeing much slower global US growth, which, as I said, we were 7%, close to 7% last year, and 3 to 3.5% likely this year. That tends to favor the more defensive side.
Okay, thank you very much. Usually, when the Fed start raising rate, the dollar start to depreciate. But now it's the opposite. How do you expect the dollar to move?
Yeah, great question. I know this may come off as just the easy response, but I anticipate more of a trading range. If you look at I've done a lot of analysis historically on asset classes and how global slowdowns have been affecting it. We're definitively in a global slowdown now because we had much stronger growth last year compared to what we're going to see this year, and often you do see the dollar strengthen at the beginning of global slowdown. So this recent move is not surprising. But if we're right that we don't fall into a major global recession, and I identify that as a global slowdown that includes US recession, and as I said, we're not looking at US recession now, the dollar actually tends to move more in a trading range after that. So one of the reasons is just the historical perspective. At NDR, we also do some technical analysis. Some of our technical models are a little more mixed to favorable for the dollar. But if you look at, say, some macro factors, they're a little more mixed. So obviously from a central bank perspective, the relative aggressiveness of the Fed versus other central banks, such as the ECB and the Bank of Japan, you could argue that's dollar positive. But if you look at other, say, imbalances, the US has relatively large negative fiscal balances, has pretty large current account deficit that's actually negative for the dollar. So you kind of weigh those risks, and it seems more of a trading range, fairly balanced.
We are in the upper side of trading range right now?
Probably at this point, yeah. And we could, because of the technical side of things, which is good for short term, we could see a little more short term upside. But yeah, probably on the upper end of the trading range.
The Chinese economy appears to be heading into recession. What do you think?
As a global economist, the US is obviously important for global growth, but China is extraordinarily important because it's the world's second largest economy and the largest contributor to global growth. So obviously I'm, trying to watch every move. Obviously the biggest downside risk to the Chinese economy is the highly contagious Omicron COVID variant. and the continuation of its zero COVID policy. So it's really interesting. Other parts of the world are more worried about central bank tightening, inflation, Russia-Ukraine crisis. For China, that says not as much of a near-term risk, could become more of a long-term risk, but not as much of a near-term risk. Most of it is due to the zero COVID policy. And from what it seems like, it doesn't seem like the government will abandon the zero COVID policy at least anytime in the near future, for a couple of reasons. Chinese vaccines reportedly haven't been as effective as the Western ones. A lot of the elderly population isn't vaccinated. Since zero COVID has remained for quite some time, there's little immunity from past infection. So, it's possible that the healthcare system wouldn't be able to support a large outbreak. There's also the ongoing downside risk from the property and tech crackdowns. But, I think the upside comes from, and this is always something that makes me feel a little more confident about the Chinese economy, is, China set a growth target of 5.5% for this year. And, I often sort of joke, but say this truthfully, that it's one of the easiest economies to, project GDP growth because, they always get it. So, I think there's a lot of want to reach that target. One is we have the 5-year Communist Party Congress, every 5 years, Communist Party Congress toward the second half of the year, where Xi Jinping will probably get announced a third term as president. So I think there's a big push for fiscal and monetary support. We're already seeing that. In fact, fiscal and monetary policy was contractionary in China last year. This year, it's now positive. There's been announcements of more to come. And I think it's also important to note that a lot of the slowdown that we're seeing in the Chinese economy, the zero COVID, the property and tech crackdowns are policy induced. So if it wants to target certain areas of the economy, wants to see growth, I think that target is achievable and can avoid recession.
South Korea belongs to an emerging market, and semiconductors, electronics, shipbuilding, and automobiles are the main industries. Do you think it is worth investing in Korean market under current circumstance?
Yeah, I mean, just tracking the South Korean economy over the past few years, it's fared relatively better during COVID. Again, got back to pre-COVID levels pretty quickly. Speaking about the Russia-Ukraine crisis, what's actually interesting is you say South Korea is an emerging market, but if you look at its CPI and its weight, so the amount of spending that goes into food and energy, it's actually in line with developed market standards. So that makes it, at least puts a little more cushion to the higher commodity prices. And then, as you said, Korea produces highly coveted products, as you mentioned, which are in very high demand. We don't provide recommendations specifically on South Korea's market, but we do have a market weight neutral stance on emerging markets. And you do see interesting patterns within emerging markets. Obviously, on the EM Europe side, closely linked to Russia, and obviously some greater downside risk in that area. The Asia portion is being somewhat negatively impacted by what's going on in China and the zero COVID policy, whereas Latin America has, at least since the beginning of the year, fared okay because of the higher commodity prices. So, there's a bit of a balance of risks. I would say on one side, emerging markets, we're starting to get rewarded for tightening policy quicker than developed markets. And that usually doesn't happen. It's usually the other way around. But at the same time, as I mentioned before, with Korea being an exception, emerging markets generally resort more of their income on food and energy. So that share of their CPI baskets is much greater. So they could be hurt more by the surge in commodity prices we're seeing.
And COVID is spreading again in the New York area. And do we no longer have to worry about the impact of the COVID on the U.S. economy?
We cannot forget about COVID. I completely agree. It's not behind us. There's still, potential downside risk from it. There's always the risk of new variants that are possibly stronger or don't react to vaccines. I'm not a health expert, so I don't know the trajectory about that, but I know for sure we cannot forget about COVID. I would say the good news, however, is if you look at past COVID waves, including the latest Omicron variant, which was huge, as we all know, they tended to slow growth, but they did not derail growth. Pretty much the COVID wave that really derailed global growth and US growth was the initial one in 2020. And I think what this really speaks to is just to end on a positive note, I guess, the adaptability and ingenuity of humans, not just on the scientific front, but also, just everyday businesses and households. So I think that's a positive side, but we can't forget about it, because if you're seeing, COVID alone, I don't think will put the US economy into recession. If we, of course, there can be very extreme circumstances, but if it's piled onto other risks, then it is a risk that we need to continue watching.
Okay, thank you. That was my last question, Sam. Thank you for the insightful answer, and I hope you see you soon. It was a real pleasure.
Oh, it was an absolute pleasure for me as well. Thank you for having me.
Have a nice day.
You too. Take care.
Bye.